you're kind of letting me go here, but I got to drill into this.
Keep
A
going.
lot of people say the Federal Reserve has control of interest rates. And if you go and you look at the data, that's not true. A lot of the times the free market rates actually lead
Yes, sir.
the Federal Reserve.
CJ, I was just about to ask you about the 2-year leading the Fed funds rate. So I'm glad you brought that up. Keep going.
Yeah. So the Fed is more reactive. The smart money in the market is actually leading the way. So the Federal, in other words, yes, the Federal Reserve may be forced to lower rates back down to zero in the future. But if the free market doesn't trust their narrative, the long term of the rates could go up. They don't have control over those rates. That's why they call it yield curve control. There's additional steps they have to take by providing liquidity, aka creating inflation, in order to cap rates and control rates. Just look at Japan. They don't have control. They're not able to state the 2-year rate or the 10-year rate or the 30-year rate. Not at all. They actually have to have an open market operation to tinker with those rates. And I wouldn't be that surprised. We were at such a critical point that, I mean, I had to make some pretty heavy statements in my threads, because we were getting to the point where if the yield curve uninverted at that 5.5%, then the process of uninversion historically has led to a 2 to 4% spread. So if the 3-month was at stated at 5.5, and the 10-year was at 5%, it was only 50 basis points from uninverting. Whenever that uninversion takes place, there's usually a huge sell-off. And that would have led to 7.5 to 9.5% rates, which imagine the interest on the national debt at 7.5 to 9.5%. I mean, right now people are concerned because it just broke $1 trillion and we're only at 5.5. So imagine that shooting up to 9.5. I mean, it would create so much inflation, so much price pressure because of the dilution of the dollar being paid back to people who then spend it into the economy. So you get it from the creation of the dollars, and then you get it from the supply demand side of people spending that yield. And the Fed, this is a real problem for them. They can state the rate lower, and the long end of the curve, the free market end of the curve, can continue to increase. But the only way that would happen is if people lose trust. So they have to abuse that trust. And that's what they're doing with this data. They're abusing trust. And it's got me a little bit like confused, because if trust is so critical, you'd want to be honest. You'd want to be able to secure people and let them know that you can trust them. Here's the data. It's not as pretty as we want it to be, but when it gets to where we want it to be, you can still trust us. They're doing the opposite. They're pulling a financial COVID. They're just simply lying about the data. You saw Biden the other day. Inflation is 0%.
I love that guy. It's unlimited content with that guy at the mic, man. I love it.
It's an embarrassment to our country. And you really think people are stupid enough to believe that inflation is 0%? If inflation is 3.2 and it stays 3.2, you can't say it's 0%. That's how you lose more trust. So all the actions that they're taking are really putting trust in the spotlight. And if they lose that trust, yields are going to explode so high that we will go into hyperinflation, because the amount of interest that will need to be paid for all of the borrowing and all of the rolling over and all of the unfunded liabilities and the continued growing budget deficit will require them to create large amounts of currency units and then to distribute those currency units into circulation so that other people can spend them. It's really bad. Now, if it goes the other way, though, like let's say people continue to trust them and the rates go down, well, yeah, you'll get less monetary inflation because there'll be a smaller burden. The interest on debt would go down, probably back under $1 trillion. So that would help with the additional currency units that have to be created. But you have to remember the supply demand aspect of price discovery, right? There's two sides to every equation. You have the currency itself, and then you have the supply demand. So you have to take the supply demand of the currency first, and you have to say, okay, is this currency stable? Or is the supply dropping and the demand going up and it's gaining purchasing power? Or is the supply going up and the demand dropping and it's losing purchasing power? That's going to create a price pressure on that transaction. But you also have to go to the other side of the equation, which is the actual supply demand for the good or service itself. Is the supply going up or down? Is the demand going up or down? And both of those price pressures play a role in that market price that's settled upon to create that transaction. So if they lower rates, yeah, on the currency side of things, there'll be less monetary inflation. But on the supply demand side of things, where's that $6 trillion on the sidelines going to go when it can't get yield? It's going to go right back into the assets, and you're going to see demand outpace supply significantly. And then CPI is going to get pushed up tremendously. It's almost the same way. So it's like you lose trust and rates go to 10 and you get massive inflation, or you lower rates and people rush out of the dollar back into the marketplace and you get more inflation. There is nowhere to go. There is no deflation. It's inflation or inflation. And only Bitcoin can protect us from this.